I want you to picture two coworkers, same job, same title, same salary of $62,000 a year. Sarah and Jordan started at the company the same month, sit two desks apart, and even order the same lunch on Tuesdays. But financially, they are living in two completely different universes, and the reason comes down to one small habit almost nobody thinks twice about. Sarah fills out every form completely. New credit card application, she writes her full salary. Store checkout offering a rewards card, she writes her full salary. Banking app asking her to verify her income for a better experience, she types it in without blinking. Within 18 months, Sarah has 4 store cards, a personal loan she didn't go looking for but accepted because it showed up pre-approved in her app, and a credit limit increase she never requested that somehow tripled her spending power. Jordan does something different. On every form that doesn't legally require income, Jordan leaves it blank or enters the minimum. Store card at checkout, declined to answer. Banking app nudges, ignored. 18 months later, Jordan has 1 credit card, a stable limit, and almost none of the loan offers that keep landing in Sarah's inbox. Same income, same job, widely different financial pressure. This isn't a story about willpower or self-control. It's a story about a piece of information you give away for free, dozens of times a year, without realizing it is being used against you. Let me start with a concept that will reframe how you think about banking for the rest of your life. Your income number is not information a bank needs. It is information a bank monetizes. Every time you type your salary into a form that isn't a mortgage or a legally required loan application, you are not verifying anything. You are training an algorithm on exactly how much financial pressure you can absorb before you say no. Banks and lenders use your stated income in 3 ways that rarely benefit you. First, to calculate how large a credit limit they can offer without you defaulting immediately, which is different from what's good for you. Second, to rank you against other customers for targeted offers, meaning a higher stated income literally moves you into a different marketing bucket. Third, to time those offers around moments you're most likely to say yes, like right after a big purchase or a raise. None of this is about protecting you. All of it is about maximizing what the industry calls wallet share, a term that should honestly make your skin crawl. Rule 1. The pre-approval is a script, not a compliment. When your banking app tells you you're pre-approved for $8,000, that number wasn't generated because you earned it through good behavior. It was generated because your stated income sits at a threshold that makes you profitable to lend to. Researchers who study consumer lending have found that self-reported income on non-essential forms tends to run higher than verified income by a meaningful margin, because people round up without thinking. That rounding error becomes the bank's opening offer. Rule 2. Know what's actually required by law versus what's optional. A mortgage, an auto loan, a legitimate credit card application, these require income verification, and that's appropriate. It protects both you and the lender from irresponsible lending. But a rewards program sign-up, a complete your profile prompt inside an app, a checkout counteroffer for a store card, none of these legally need your income. They ask because you'll usually answer. And that habit of automatic compliance is worth exactly $0 to you and potentially thousands to them. Rule 3. Every unnecessary income prompt is data harvesting dressed up as convenience. The phrase, "for a better experience," should be a red flag, not reassurance. A better experience for whom? Financial apps that collect optional income data use it to build a profile that determines which ads you see, which loan products get pushed to your dashboard, and how aggressive those pushes become. You're not getting a better experience, you're becoming easier to sell to. Rule 4. A higher stated income doesn't just get you a higher limit, it changes your actual behavior. This is the part that surprises people. Behavioral finance research consistently shows that people spend closer to their available credit limit than to their actual budget, meaning the limit itself becomes the target, not a ceiling you're trying to stay under. So when your reported income pushes your limit from $3,000 to $9,000, you haven't gained flexibility. You've gained a much larger number, quietly reshaping how much spending feels normal to you. Over just a few years, that shift alone has pushed households into 4- and 5-figure balances they never intended to carry. Rule 5. What actually protects you isn't secrecy, it's your debt-to-income ratio, and that number belongs to you, not to any app. This is the ratio lenders genuinely should see, the ratio that determines whether you can safely take on a real loan for a home or a car. Keeping that number healthy, generally under 36% of your gross income, matters infinitely more than whatever a shopping app thinks your salary is. Guard the number that protects you, withhold the number that exposes you. Here's how to actually put this into practice. This week, go through your 3 most used financial and shopping apps and check your profile settings for any income field you filled in voluntarily. If it's not attached to an actual loan or mortgage, delete it or set it to the minimum the app allows. This month, stop answering income questions at checkout counters and on new account signups unless you are specifically applying for credit that you initiated. A simple, "I'd rather not share that," is a complete sentence, and cashiers hear it constantly. It will not slow anything down. This quarter, pull your actual debt-to-income ratio using your real numbers, not what's stored in some app's database. Add up your monthly debt payments, divide by your gross monthly income, and know that number cold. That's the figure that should guide your borrowing decisions, not a pre-approval banner designed to catch you at a weak moment. Back to Sarah and Jordan. The difference between them was never income, and it was never intelligence. It was one small repeated decision about what information to hand over freely. Sarah's habit of oversharing fed her into a cycle where every convenience prompt turned into another credit line, another temptation, another payment. Jordan's habit of quiet withholding kept the same salary working for Jordan, instead of working for a lending algorithm somewhere. That's really the whole choice, laid bare. You can keep treating your income like small talk, handing it out to any app or counter that asks, and let that information get used to calculate exactly how much pressure you can take. Or you can start treating it like what it actually is, private financial data that only belongs on forms where you initiated the request. The choice is simply whether your income works for you or works for everyone else who's asking for it. This video is for educational purposes, not financial advice. Speak with a qualified professional for decisions about your specific situation.